The Fed's next interest rate setting meeting happens next week on Friday, just before the Fed went into its regular pre-meeting quiet period. Fed Chair Jay Powells said that the central bank's efforts are working to slow inflation. But he also said officials are being cautious and that the full effects of rate increases have probably not been felt yet. Joining us right now is former Fed Vice Chairman and CNBC contributor Roger Ferguson. And Roger, we have spent a lot of time trying to decode the Fed's words. And I have to say, I think you're probably better than just about anybody at doing that. So why don't you tell us what Jay Powell is saying right now? Because we have some people who are thinking the Fed's going to cut rates by March of next year. We've got other people who think it's not going to happen till the end of next year. Where do you come down?
Yeah, I come down in between. So let me be clear about what I think Chair Powell is saying. I think one is saying something that everyone is observing, which is, in fact, the economy is softening as they had hoped. Inflation is coming down. The 12-month core PCE was 3.5, but the 6-month core PCE was much lower than that, starting at the 2 handle. So that's probably good news. I think what he's worried about is, he's lost control of the narrative just a little bit with the expectation of a quick cut. And I think they want to avoid the old stop and start concern, which means they may hang on just a little longer than markets expect. Now, they will have the other challenge for them, I think, is that the financial conditions, which had been tightening, supporting their narrative, are now starting to ease. And so I think they're caught in a little bit of a dilemma. They see things coming out the right way. They see inflation dropping. That should give them some room to ease. But I think they don't want to be premature because they also know there's a risk of the economy restarting with the loosening of financial conditions. So it's a complicated story, Becky.
A complicated story. We've had people who say, look, this could have a really big impact. We could eventually fall off a cliff, that the Fed is going to be overly cautious because they were slow to start on this anti-inflation campaign. And as a result, they think they're going to be slow to take their foot off the brake because they don't want inflation resurging. Is that your understanding, that the Fed is going to err on the side of caution?
I think that's probably, if one had to think about the two risks, that's probably where most of the risk lay right now for exactly that reason. You may recall, Becky, I've been somewhat worried all along throughout this around the possibility of a bumpy kind of landing, maybe short, shallow recession back in the air again, for exactly that reason. I think having started late, worrying about history, seeing that there's some still surprisingly good forward momentum in the economy has been, the big surprise of 2023. They don't want to be fooled again. And I think all of that means perhaps, overstaying their welcome with the foot on the brake, as you described, and risking, maybe a bumpier landing than many of us would hope for.
As the former vice chairman, you understand very well the pressures that play out and what the considerations are in the room. We've had a lot of people talk about the political aspects as we head into an election year. And obviously, the Fed's supposed to be apolitical and not bow to that pressure. But we have some people saying, look, they're going to be pressured to cut rates if the economy starts to slow in an election year, or they are going to be pressured to not cut rates to look like they are helping the current administration. How does that play out? And I know the standard operating line is we're an apolitical organization and we don't look at that, but there has to be something that kind of takes place, at least in the minds of people as they're making these decisions. They're human.
Look, lots of things take place in people's minds. As you say, people are only human. I think they really are, particularly this year, going to hew as close, or next year, as close as they can to the party line. And I think part of the issue is the economy itself. To the Fed neutral, straight down the middle line. Thank you for allowing me to clarify.
Yeah.
And I think the economy itself is going to be throwing so many curveballs that whatever they do, they're going to look like they're favoring one over the other. But I think the reality is they're just trying to go through this very complex situation. And they're going to have to be prepared for, cat calls from one side or the other, because whatever they do in the election year is going to look like it's favoring one party over the other. But I think the reality is the underlying circumstances are what's creating the uncertainty and the tension, as we've just talked about.
So let me ask you this. What would it take for the Fed to consider cutting rates in the near term? Is it that we are facing some sort of issue that breaks the markets in some way, shape, or form? Is it enough to say that the unemployment rate starts rising? Would that make people say, hey, maybe we need to not just take our foot off the gas, but actually drop rates a little bit to take some of that pressure off? Like, what would it actually take for the Fed to cut rates in the first half of the year?
I think there are two or three things that would lean in that direction. One, I think you're probably going to talk about, which is a lot of talk about the consumer and consumer softening. If there's real evidence of that occurring, that I think would be very important to them, because after all, 2/3 of our economy is very much driven by the consumers. There's certainly some concern about stress in the banking sector. We know mark-to-market losses, concerns about commercial real estate. So if I had to look at what we call financial stability concerns that might lead them to cut maybe more quickly than they currently expect, that might be a second place I would look. So those are two areas. Obviously, the possibility of some international occurrence, but that seems less likely. So I think the issues are more domestic. They're about consumers. They're about real estate and banking. And perhaps third, the manufacturing sector has been soft for some period of time. If that starts to leak across that to other sectors, that might be a problem for them as well.
I mean, Roger, the reason I ask that is because there's a lot of almost enthusiasm in the markets when you look at equity prices, when you look at a lot of other places that, right, hey, the Fed's going to cut rates and that's going to be great news. But my understanding from how I read this is if the Fed cuts rates in the first half of the year, it's going to be because the economy's in big trouble. So maybe it's not something that's worth cheering.
I agree with you completely. I'm not sure how to use the word in big trouble. I think, if they are cutting rates in the first half of the year, it is because they are more concerned about a slowing than they are about a restart. And I think, to your point, that does not necessarily support the, happy days are here again, everything rally that we're currently seeing in the market. Look at what's happened with the 10-year. Look at what's happening with small and mid-cap equities, gold for people who watch that. You're talking about cryptocurrencies. Almost every place you look, asset prices are rising very rapidly. And that's a sign that the market expects a very easy move to a soft landing. I think the market may be overdoing their expectations just a little bit, and I think the caution is what's called for, and I think that's where the Fed's head is. But as we said, that caution might in fact be overdone and could lead to the outcome that they're trying to avoid. So very, very choppy waters ahead, even though it seems very placid to many people right now.